Iryna, it would be good to pick up, I think, a bit in terms of particularly the debt markets and what you're seeing there at INREV.
Well, there's quite lots to be said about the debt market. I think what we are seeing is some interesting times ahead. I think when it comes to the non-listed real estate debt funds, we have seen growth in that component of the market for the last few years, quite a significant one. But the current market conditions might help to accelerate some of that growth even further, particularly in the kind of senior lending space. And this is an opportunity again to step into that financing gap that traditional lenders have left open. I think what we also see is because there is so much pressure for European commercial real estate to decarbonise, this is an opportunity for non-listed real estate debt funds to also step in with the ESG debt focus proposition. I think that would be fascinating if they do.
And do you expect, given the situation at the moment with bank finance and the more sort of conservative view, do you think there's a bigger opportunity at the moment for the non-traditional lenders to maybe replicate to a certain extent what there is already in the US here in Europe?
Yeah, well, it takes time. So I think we're already on that journey, so to speak. So if you look at the UK market versus the continental Europe, we have already seen acceleration in growth when it comes to non-traditional lenders and them stepping up in terms of new lending activity and even overtaking the traditional lenders. The continental market is a little bit further behind, but the direction of travel is very clear. The funding gap is big enough, and of course, remember, there is maybe some stress coming through because of the market fundamentals. All things are made equal. That opportunity is there. It will take quite a bit of time to service anyway, so I think it just probably will move forward faster than it may have been otherwise.
Great, really interested to catch up. Thanks for joining us, Iryna.
Thank you, Richard.